Hello and welcome to this presentation video on my algorithm. There are several topics that I would love to cover in this video, so I'm going to jump right in. First thing I'd like to talk about are some features that my algorithm has incorporated into it. Overall, I can say that the basic idea behind the algorithm, or what my inspiration in designing this algorithm is I thought logically, or I had an intuition when I first started working on this algorithm, that there should be a way to trade the market such that you never really suffer risk. In other words, what you end up doing is due to the mathematical limitations of what price can do at any from time A to time B. For example, price could only ever go up, go down, or stay the same. Ultimately, due to those constraints, there should be the possibility of always hedging your risk in such a way that you are never running net negative in the market. And that's what I, after 8 years of arduous work, have created. And what I'm presenting to you here today is my algorithm runs in such a way that it manages risk, and it does so that the total net equity at any given point in time should never be negative. And the example that I'm going to use in this, I'm going to use a theoretical account balance of $1 million, and I'm going to demonstrate the results of what the algorithm produced using 3 different asset classes. One will be currency, one will be commodity, and one will be an index. We'll be looking at the S&P 500 index, and we'll be looking at various time frames, longer term time frames, since we just had 2019, and I thought it appropriate to look at what it would have done, for example, over the course of 2019. So in this particular video, I'm going to look at the pound versus the yen, and we're going to be looking at an H1 chart. And what that simply means is that each one of these bars on the chart represents 1 hour in time. And one of the features of this algorithm, before I get into the actual trading engine and what the trading engine is doing, I just want you to take a look at these dots and arrows. And these aren't particularly, this isn't the trading engine, but this is just giving an example of some proprietary indicators that I developed in order to make the trading engine. And dots below typically indicate price support, and dots above typically indicate price resistance, that the market's going to find price resistance. It's beyond the scope of this video to explain how I derive each of these, but simply speaking, they are statistically significant, and they are as well, it's based on statistics and a bit of calculus, I can say. And like I said, all of the indicators that I use were custom built. They are proprietary, with the exception of one that is in the public domain, which is J. Wells Wilder's ADX index, and that I found that indicator to be truly brilliant, and so I preserved some of what Wells Wilder did with his indicator, but I modified it in order to be able to think with what it's doing a bit better. I don't need to get into that too much further at this point. So I'm just indicating what my, I'm just trying to show what my indicators are and their relative strength and how decent they are at predicting price motion, or at least indicating relative prices. So, or where risk to prices are at the present moment, I should say. So if we want to now look at the actual trading engine, there are what my algorithm, in order to solve for the supposedly infinite possibilities of price from time A to time X, it would seem as though there are an infinite number of possibilities, but without getting into the mathematics, all you really need to do is to solve for two general cases. And those two general cases are one in which a market is trending, and the other is in which if a market is oscillating within a range. And basically, I have two algorithms running simultaneously because the market doesn't announce ahead of time whether it's going to oscillate within a range or trend. And so you will see that they're both broken into long and short, short and long, short and long. So this is the trending algorithm on top, short and long, and this is the range algorithm on the bottom, short and long. And you can see during this nice little bull market run after this capitulation candle early in the year and then run up, the long side is very positive equity, whereas your short side really doesn't have too much to worry about here, just a very small negative equity. And similarly with the range trading algorithm, the long side is taking profit all along the way. When the market starts faltering around here, which is the 27th of February, you see it enters and very quickly exits positions as the market demonstrates that it's not really going to fulfill the conditions that this algorithm is looking to fulfill, but rather, as you see, we start moving into, after these 2 months of stagnation, we see a sell-off in the pound versus the yen, and the range algorithm on the short side starts taking positions and taking profit. And you can see that the the trending algorithm, as you see, doesn't have any real preset take profits or exits. And the reason for that is because this algorithm, as I will show you in another example, is really meant to capitalize off of a movement from one price to another price over a fixed period of time. So, for example, if you were going to run it as a day trader, first of all, you wouldn't use the hourly chart because there aren't enough data points in an hourly chart to day trade with. You'd use, for example, a 1-minute chart, and in a 1-minute chart, you would basically just close out all positions at the end of the day, and whatever the cumulative change was in that particular day, you would see that the algorithm, either long or short, would be net positive at the end of the day. So because we're dealing with the pound versus the yen, and this last year, this 2019 year, was very volatile for the pound versus the yen. We had move down of 3 or 4% at the beginning of the year, followed by a move higher of about 7 or 8%, followed by a move lower of almost 13%, as you can see here, followed by a move higher once again of almost retracing that entire 14 or 15% loss, 13 or 14% loss in the summer months. As you know, Brexit is on the table, and that is what's causing a lot of volatility of the pound versus the yen. So if we fast forward to the end of the year, I just want to show you where we stand at the end of the year. For the trending algorithm, the short side is down $430,000. This is on a hypothetical $1 million account over the 4 algorithms. The long side is up approximately $930,000. So the trending algorithm over the course of the year is up in total a net of about $500,000. And the range algorithm is up on the short side, we can call it around $90,000. And the long side is up about $470,000, so another $550,000 for a total gain between the 2 algorithms of well over $1 million. So as you can see, the algorithm doubled money over the course of the year. That is actually not the most significant aspect of this that I'd like you to focus on. What I'd like you to do is take a look at how well risk is managed the entire way. You never have even one day in this entire year where you are running where you are holding an equity that is lower than your initial investment. In other words, you never open your account on any day of this year and see your account less than $1 million. It's always from day one greater than $1 million. And going from $1 million to $2 million without ever running at any point a drawdown on the initial principal is what makes this algorithm stand out from other algorithms. Typically, a lot of other algorithms are running strictly based on statistics. They're trading setups. For example, this has been shown to be a statistically significant setup to the upside or to the downside, and then setting and adjusting risk. That's not at all the class or category of what this algorithm is. Those algorithms are relatively simple to develop. I say relatively simple to develop. Perhaps they'll take a year or something in order for a good developer to develop an algorithm like that. This is a perpetual risk management algorithm, which is really in a class of its own, and isn't just trading setups. It is truly for a large hedge fund or a large investment fund, a multi-billion-dollar pension fund, to be able to manage risk in any asset class that it happens to be invested in. That would be the highest and best use for this particular algorithm. But we can talk about that a little bit later. I want to show a couple other examples of what this algorithm did using different asset classes. The next one I'd like to look at is gold versus the US dollar. And actually, on this particular algorithm, I was able to download up to 2 years worth of 1 hour chart data. So we're going to go through this on a 2-year basis, and I'm just going to show you what the algorithm did. You can see that at the beginning of 2018, really up until April 20th, there was just a lot of up and down on gold. It was holding roughly between $1,300 and $1,360, which is really quite a tight range. You can say less than about a 4% range, or a little bit less than that, over the course of about 4 months, until really the 10th of May is when it breaks through, and then there is quite a significant sell-off in gold, and it does recover roughly around the end of September. You start seeing signs of a market turnaround, and at that point you have a nice, healthy, strong bullish close into the close of the year. Not quite above the open price of the year of 2018, but very close to it. And that sets up for bullish action in 2019. And just so you see that I'm not trying to hide anything, on January 1st, if you just wanted to see what did it do strictly in 2018 to 2019, not 2 years, but 1 year, just to compare apples to apples. Your short side is down $150,000, as you can see over there on the right. Your long side is up $963,000, so a net gain of about $830,000. Your short side on the range trading algorithm is down $56,000, and the long side is up $426,000, so a net gain of $370,000. So all in all, a net gain of about $1.2 million over the course of the year. So again, more than doubling money with very low risk, almost no drawdown anywhere in this chart. The total net equity is never running below your initial investment. But as you can see, there's an opportunity to potentially, an immediate opportunity to improve what this algorithm is already doing is, as you can see, already present. There could be some machine learning or reinforcement learning done in order to really squeeze out the highest possible gain from this trending algorithm, because as you see, there's often times where as we saw in the pound versus yen, where you have these massive positive equities that don't get liquidated and the profit doesn't get taken, and then sometime later in the year that diminishes and it's gone. But you'll see why I developed it that way now, as you see gold moving into 2019 to December 31st of 2019. You see a really healthy bull run that remains until the end of the year, and as a result of that, what you get at the end of the year for the trending algorithm is minus 1.15 million on the short side. You have positive 6.19 million on the long side, so you're up $5 million between short and long on the trending algorithm. And on the short side, on the range trading algorithm, you're up $175,000 on the short side, and you're up almost $1 million on the long side. So all in all, you're up about just a little over $6 million on a $1 million account. And again, this is all done with probably not even 1 day of running a negative equity on your initial balance. So there's one last one that I want to show you, and that's the S&P 500. And unfortunately, this particular broker that I was using, I was only able to download data from basically March 1st of 2019. So I only have 8 months worth of data in the S&P 500, and you can see right where it starts, we have a real choppy market. It goes down from rejecting this 3,000 points valuation on the S&P 500, falling down to 2750, almost 10% less, climbing back up that 10% by August, and then within the first 2 days of August, we had a steep sell-off in which the market liquidated about 10% of its valuation in the course of 2 trading sessions, and then you have it kind of really jerking all over the place, really steep sell-offs followed by slow and quite volatile recoveries. Perhaps you remember that from this year, and then finally moving into a bullish market in the fourth quarter towards the end of the year, having a nice clean bull run. What you find at the end of the algorithm here, and this is the aspect that I really want you to see because this is quite interesting, you finish the year with the short side losses almost exactly equal to the long side gains. So that feature is not just an anomaly. What that indicates is that the market was more in a range sort of atmosphere than it was in a trending atmosphere for the bulk of the year. And even though the market posted 25% gains over the course of the year, for the period that we looked at, it was really more or less stuck in a trend from the end of April until the end of the year. So what you have is the range trading algorithm. You see the short side is just holding its positions. It's now right about break even. It finishes the year at $7,800, which is really nothing, basically at break even, and it finishes the long side range trading at positive $758,000. So you see, if we didn't have this second algorithm, you would have taken on all that risk, taken all those positions, and wound up net equal if you only had one algorithm. So that is one of the real beauties of this, is that regardless of what type of market you're in, you're always going to have an opportunity to profit, as this particular year in the S&P 500 has shown us. So those are the major features and results that I wanted to discuss. Now what I'd like to talk about is the future of this algorithm. Basically what I've demonstrated here is simply proof of concept. And as proof of concept, all I mean to do is sort of pique your curiosity and interest in this. I fully expect people to be highly skeptical of my results, and I just want to reassure you that I am willing to put my algorithm through whatever paces you want to put it through. Any asset, any time frame, any regardless of anything, like whatever testing conditions you want to produce, as so long as they are real prices, not fictitious prices. And the reason I only have that caveat or that demand that they be real prices rather than fictitious prices is because my logic that is built into this algorithm is based on the way prices really move, not on the way prices fictitiously move. So as long as it's, from now to the beginning of time, if you have an electronically traded market and you can get me a data sample of any time period, I would be happy to run that time period through my algorithm so that you could satisfy for yourself that this proof of concept holds. And the next step that I would like to take with this is I'm looking to work with some investors to take this now into the startup phase. What needs to be done is a back end needs to be built. The back end trading interface between the algorithm and the exchanges needs to be built, and I would like to work with some well-capitalized investors to begin this next phase. It can be a privately held fund or with an eye towards a publicly held, a fund open to the public investment if that seems to be its highest and best use. Of course, we're going to run at some point into liquidity limitations. Obviously, you can't liquidate $100 billion in positions or something like that in many markets, and so therefore we need to there are limits to the amount of profit that can be made from this algorithm. So it may be in the end that a privately held fund is the highest and best use for my algorithm. But besides that, as I mentioned, there could be some machine learning, some more dynamic exiting that's looked at just to tighten everything up. I highly doubt there's going to be anything that a machine is going to learn about this that is going to drastically change the overall concept. I did dabble in some machine learning when I was optimizing this algorithm, and they wasn't really all that impressive, to be honest. But then again, I don't have access to the top level, AI scientists out there, and I don't know what possibilities they could come up with as far as machine or reinforcement learning. So I leave that as an open possibility to collaborate with people who are more knowledgeable than I in that particular area. But if you are interested in working with me on this project, I would love to, or simply just talking about it, or simply demanding more testing for my outrageous claims that I can double money in a year with no drawdown over the over several different assets. But to be honest, my feeling is that its highest and best use is in the cryptocurrency market. And the reason for that is the cryptocurrency market is extremely liquid. And it also has, it's still averaging about 10% per week. And so these moves that you see in the legacy markets, in which 10% takes several months to play out in order to double money or something like that, can happen sort of in just a single week in the cryptocurrency market. And the markets are highly liquid. Bitcoin trades more than Apple stock, for example. So I think that building towards the cryptocurrency market and striking while the iron is hot is really the highest and best use, in my opinion. But as I said, I'm really open to discussions of all sorts with investors on my algorithm. If you'd like to speak with me further, my email address is pratgoel@gmail.com. Again, pratgoel@gmail.com. My name is Pratik Goel, and I really thank you for your time and your attention and your consideration with my algorithm. Thank you.